into the financial reporting of post-employment as well as share-based compensation plans. So as you might have guessed, we are talking about employee compensation. So the employees that work for a certain organization, we would like to compensate them first of all for their liquidity needs, the cash needs that they have, right? We want to motivate them so that they continue to work for the company, and of course this has to be done in terms of multiple different ways or components of compensation. Now, the most obvious one is salary, but then we don't want them to only play it safe with the company, right? We want to align their interest with the growth of the company, with the profit of the shareholders. So, what you can offer them is something called bonuses or share based compensation, and this really helps align the interest of the employees with those of the shareholders, because shareholders are obviously looking for higher profits. Now, if you give them a fixed salary, if you give all the employees a fixed salary, they won't have that interest in growing the company and growing its profitability. But if you offer them bonuses which are linked to the short term and long term performance of the company, and if you offer them share based compensation, which means, let's say the stock price of a company's share is $40, and you offer the employees to be able to buy the share from you at 50, so they will work to increase the company's performance and drive the share price up in the market so that they buy from you at 50 and then sell in the market at 60. So these are ways to align the interest of employees with the shareholders. And the other two are non-monetary benefits and pension. So before I get into pension, let me just talk a little bit about non-monetary benefits. Here you've got health insurance, life insurance, which of course has a monetary component to it, because the health insurance is going to have a limit on the amount that is covered, and the life insurance of course will have a dollar amount or a monetary amount to it as well. But these are different than your salary and bonuses, and hence they are referred to as non-monetary benefits. But the main one that we're going to be focusing on in this video is pension. Now that of course is the cash that the employees will get once they are post-employment or once they are in their retirement. So pension plans of course are going to be discussed in a lot more detail at level 2. At level 1, we're just going to develop a high level understanding of this topic. And what we need to pick up is that why and how pension can become a liability or an obligation for the company, right? Because there can be one of two situations. One is if the company gets into something called a defined contribution plan. This is much easier than a defined benefit plan. This is much more complicated. And the reason for that is, with a defined contribution plan, the company just has to put aside a certain amount of contribution which is defined every year. So there's no complexity over there. It's very, very simple and straightforward, that as far as the company is concerned, its responsibility is only to set aside a certain amount of money, right? So the accounting is very, very simple. However, if you're going for a defined benefit plan, here it becomes very, very complicated, because here the company is basically saying that we are going to pay a certain amount of money to each employee who has qualified for this pension, and that is going to be paid until they are alive, right? So until death. So it becomes very complicated to try and predict when will people be alive till, right? So what will be their average age, and then how much money are you really setting aside, and is it enough for this liability that you have taken on? Is it more or is it less? And that's where things become complicated, and that is your defined benefit plan. So in a defined contribution plan, as discussed, this is very straightforward, that the company just agrees to contribute an agreed upon amount to the plan, right? Every year, the expense will be recorded on the income statement equal to that agreed upon amount, and the company will just pay that. It will be recorded as an expense on the income statement and as operating cash flow on your cash flow statement. And since there is no future payout or obligation for the company because they've agreed upon a certain amount and paid it, there's no liability reported on the balance sheet, right? So let me just go back 2 slides and emphasize on this point over here that pension and other post employment benefits give rise to non current liabilities. Yes, that would happen if we were talking about a defined benefit plan. In the case of a defined contribution plan, it hardly gives rise to a non current liability because you're not really taking on any obligation. You're just agreeing to set aside a certain amount of cash every year, which is recorded as a pension expense on your income statement and in operating cash flow on your cash flow statement, and that's it. The only possibility of a liability being recorded, and this is not a non-current, this would be a current liability, that during any given year, let's say you haven't paid that amount which you agreed to pay, so it's like a current liability that you still have to pay it by the end of the year, right? And for some reason, if you're not able to pay it within the year, then you have to pay it within the next year. So you just carry forward a current liability, but it's not really a long-term liability, so therefore it will not be a non-current liability. Now, if you're talking about a defined benefit plan, of course, we are getting into the world of non-current liability. So here, let's say the company promises to pay an employee annually 60% of his last salary until death, right? Now, multiple complexities are going to come up over here. First of all, what is the age till which this employee is going to be alive, right? So that is where actuarial science comes into play, and actuarial science is going to help the company come up with an estimate for the average age till which their employees will be alive. Secondly, discounting comes into play because the liability that you're going to record is not going to be the actual dollar amount that you expect to pay all these people. It's going to be the present value of that dollar amount, right? So then what should be the discount rate to use, and all that complexity comes up. Then what happens is that you're going to set some money aside to pay these future payments, and that is known as the plan assets. And what we really have to check then is that are the plan assets greater than the amount of the obligation that we need to pay from those assets? And if, for example, the plan assets are greater than the liability, right, the pension liability, then what we have is a net asset, right? We have more money set aside than the present value of the future cash flows that we have to pay out. So this will be shown on the asset side of the balance sheet. If it was the other way around, that the liability is greater, then what we would have is a net liability, and then it would be shown on the liability side of the balance sheet. And that is why all this accounting is much more complicated than it would be